Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to the AJ Brown Show. My name is Cyprian Francis, and the international man himself, Mr. AJ Brown, broadcasting from a new location. Am I right?
You're absolutely right. My family and I drove up to Providence, Rhode Island, where we are right now. Some of my friends, many of you guys know that, well, first of all, I prioritize kind of like having a lifestyle, and that this trading and looking at the markets is more of a destination, right? I like to generate an income. My peers call me the most disciplined options trader. I actually think they call me the laziest options trader. I like to think of myself as the most efficient one because I like to do everything in the evening after my toddler has gone to bed, and then be able to trade the next day through automated bots, right? And that gives me the freedom to be able to jump in the EV and drive all the way up to Providence, Rhode Island from Washington, D.C. in order to see my friends who came into town from Italy. Those of you that have been with me for a while, you know that I did Trading Trainer. I ran Trading Trainer from Italy in 2014 and 15, where I met this great group of people, and one of them is an aerialist, a circus performer, and they're actually going to be here in Providence, Rhode Island, hanging from a crane over the city on this huge giant ball and cube, and they're going to be doing all these crazy acrobats about 100 feet in the air. It's going to be awesome.
Sounds dangerous, but also sounds like it's going to be an exciting thing in the town. It should be a lot of people coming out. It's good that you could support your friends. And
if you're in the area, if you're in the New England area, I mean, Providence is throwing this huge street festival. The city of Providence is throwing this huge street festival, and I'll be around, so maybe I'll bump into you.
Hey, hopefully we have some Rhode Island Providence fans that can join you. But let's dig into what's happening in the market today. I feel like the week everyone was kind of waiting for today's employment numbers, which is having a pretty significant effect on the market. What are you seeing this week? I know we've been looking at the charts in that they may be pulling back a little bit. We saw an extension of that. Volatility is picking up a bit. What's capturing your attention the most?
Well, I'm going to take it back a notch. Let's get it from the beginning here. So starting on Tuesday, we had a couple of things. So don't forget, Monday was a holiday, and we know that investors come back from the Labor Day holiday, and they come back in force. And they sure did this week with some selling off. What happened on Tuesday, of course, is we got some notes from the manufacturing sector. Manufacturing sector said it was dropping people like flies, meaning dropping labor by dropping a lot of labor force, right? Because manufacturing has really contracted. And we then also got some hints that construction spending had dropped, and people were just starting to get worried about employment and whether things were cooling too far. People have this thought about maybe a hard landing instead of a soft landing. And so that started some selling as soon as people got back from the holiday. Then come to Wednesday, right? On Wednesday, we had factory orders way down. The job opening and labor turnover survey, interesting. Let me go ahead and pull that up on the screen. So it says that there's 7.673 million job openings, right? That pretty much means that anybody who wants a job who doesn't have one can find one here in the States. But that's a smaller number than it has been, right? What it has been over the last, say, 18 to 24 months is that folks who wanted to find a new job would have 2 or 3 possibilities. And so just the market responded to this job opening and labor turnover survey with more selling, right? Even though it's not bad news, if you look at it trended over time, respectively to the more recent news, it does seem bad news. And then the Beige Book came out. This is the details of all what's been happening in the various Federal Reserve districts in the United States, and it was pretty soft. So this just added to some fears about what's going on. Then, of course, Thursday rolls around. We get our unemployment numbers. We get the ADP, which is kind of a third-party report on employment, and it shows contraction. And then, of course, we get today. So let's pull up today's employment numbers. Let's take a good look at what's going on here. So first of all, again, job growth, if you just look at the number, 142,000 jobs, that sounds, absolutely stellar. But the truth is last month we revised our number down, 114 went to 89, and we were expecting 160,000, and we only got 142,000. Now, on the good news, somehow the unemployment rate dropped. Now, remember, when the Bureau of Labor Statistics gathers this information, it's two separate ways that they gather the data. So this is actually queuing up and questioning employers, whereas this is actually surveying the public. So they're saying that the unemployment rate actually dropped, but at the same time, the number of jobs, I almost feel like people are realizing that they're not going to have the choices that they had before. And so they're either hunkering down and staying put at the job that they're currently in, or if they had some opportunities in front of them, they're now grabbing one instead of leaving it in limbo. You can see here as well, just like the Institute of Supply Management said about manufacturing. Manufacturing has been losing a lot of jobs. Private payrolls didn't create as many jobs as possible. Still, participation rate is high. Average work week still strong. Earnings are up. So even though people are having less choices of different jobs they could go to, they're making the best paychecks they've ever made. So, all that to say, folks in the investing world, let me go ahead and shrink this down, have not been too positive. They're worried about if the Fed is in control or not. So you can see on my S&P 500 chart, there's been some selling. This is the Tuesday selling. There was some down on Wednesday, Thursday, and then today with the employment report, there's more selling. So there's some selling. And like you mentioned, if we take a look at the VIX, which is how, a measure of people insuring their long-term trades, you can see that on Tuesday that jumped up and it stayed up. And it's, last week we were talking about it being between 15 and 17. Now we're talking about it being above 22. If I show you all the data SIP from the beginning of time, and we have that linear regression line or that best fit trend line, and we kind of bring it forward, you can see we're now popping back up above that median or mean number. If I bring us back down to the more recent, now that I've extended that number, you can see we're trading above that line, which means we're more on the fearful side than the confident side of the VIX.
And it seems like all that makes sense, right? Because the data isn't exorbitant one way or another, right? And so we have to digest that. And then when you've been doing your regressions of the S&P, we did have some of those areas. And I know we posted a video on YouTube a couple of days ago of a breakout. We didn't really know if it would be up or down, but it seems to be now heading in that down direction. And, as a trading trainer participant, as you've been putting on positions, or the community has, to take advantage of this. But let's visit the regression real quick, because this purple now kind of means that we may be in some chop here unless it breaks to the downside even further.
So this purple would be a halfway mark. We actually think it's going to get to the red In fact, so Sip, I got to wear two different hats. There's the hat where I'm like a US and world citizen worried about the economies around the world and what that's going to mean. And then there's the hat that I wear that's the investor. And one of the reasons why I chose options as, my vehicle is not only because I could automate this whole thing and there's all sorts of strategies, but when I was, sitting down, figuring out, do I want to do Forex? Do I want to do commodities? Do I want to do futures? Options jumped out at me because I can pretty much figure out how to make a profit by combining options into different option trading strategies, and also just the selection of options themselves, whether I go deep in the money, I go out of the money, I go at the money, whether I go near or whether I go far out in expirations. You can tune these things to profit pretty much on any situation. So what we want here at Trading Trainer is for this to go back down into the red zone. We like that it has been going into the red zones since about May 31st, right? May 31st is when this new trend started, this sideways choppy trend. And we like that, right? Because like we saw, VIX says premiums are high. What we're doing here at Trading Trainer is selling options. Options are at an all-time high. People are buying options left and right in order to protect their investments, and we're on the selling side. So we're making more money than we've thought. So we like it sideways choppy as investors. We want this to actually dip down below this $5,362.84. If we can get close to this number down here, that's where we want it to be as investors.
And we'll go through a few examples later on in the show. We'll go through your pick of the week. We'll go through our speed round. I do think it's worth pulling up the expectations, right? Because all the pundits are basically saying we have this new data. The Fed is going to raise by quarter basis or drop by quarter basis point or a half basis point. And that decision, it's starting to seem like it's going to be a major decision that if it is one or the other, the market is going to react. So what is the market thinking today from the news that's coming out?
I mean, okay, so the Fed, the bottom line is right now, coming September, we're swaying towards a half-point drop. That's what the market is pricing in, right? They think that the Fed is going to drop. Now, the Fed has not given any hints to this whatsoever. The Fed has said, hey, it looks like it's time to start thinking about dropping rates. We have to, handle employment. Honestly, the employment numbers were not so bad. The Fed has been really hinting heavily at a quarter point. They keep saying a measured, but the market is, and the market is an overreactive, little hussy. And the market has, as of today, they're factoring in a half-point rate drop. I get that. I keep saying hike, but I meant drop. They're factoring in a half point. But if I was a betting man, I'd stick with that whole measured thing. The Fed never really overreacts, so I think they're going for a quarter point rate drop.
Especially with how many non-moves we've had. Like how many months is that? Like it's almost a year of not going one way or the other.
I don't feel like they're going to be chasing anything. So even though the market is hinting at a half, I'd be surprised if we got more than a quarter. Now, in November, check this out. The market is pricing in, after they priced in that half, they actually think the Fed's going to drop at a quarter in November as of right now. Again, I'm thinking quarter. They're thinking half quarter. And then in December, check this out. They're thinking another half. So they're thinking the Fed's going to go half, quarter, half. As of today, that's what this survey is showing, that they're thinking half, quarter, half. I think that I'm going to take Jay Powell by his word. It's going to be quarter. And, but basically we're pricing in anywhere from about 3/4 of a point rate drop to a 1 1/4 point rate drop by the end of the year.
And if you look at it in that respect, that seems to make more sense, because I feel like if the next Fed meeting they came out with a half-point cut, that would probably be seen as bad, right? It's like, oh, we got to play catch up to the mark, right? So
and I don't see this Fed.
I
don't see this Fed wanting to create those fear, because it's like a vicious circle. If you actually play into the fear, people start selling even more. So I agree with you. I don't think they want to, stoke that fire.
And they do have the power of just using certain keywords in their rhetoric to say, hey, it's only a quarter, but we almost made it a half. And then, that's almost as powerful as making it a half, right?
Yeah. I mean, if you look at the overnight lending rate, it really doesn't have the effects on the economy. Like when they switch that interest rate, it doesn't have the effects on the economy more than just the words and the emotional sentiment behind it, because you're causing behavior changes. You're not the actual tactical movement of raising or lowering interest rates has only a certain amount of effect, and it usually takes 5 or 6 months for it to kick in. It's like you said, the rhetoric and the emotion and the thought process behind it and the feelings that it elicits that changes people's buying and selling behaviors instantly.
And all the greedy traders, investors who want to find an edge and make some money, which is why we're here, which is why you created the program.
They've been jumping into bonds. I mean, they kind of pulled out a little bit today, but they've been taking their money out of the markets and putting it into the bonds. It's interesting. We haven't seen the big uptick in gold. Gold's still at an all-time high, but it hasn't changed. Instead, we saw money move from equities into bonds.
And I also keep hearing that September as a month historically is kind of all over the place. And then September in an election year, it's just, we had some excitement in August, which we didn't expect. We're starting to see some excitement continuing in September, and that's why we encourage everyone to come be a member of the program, right? Come get some information, come get some insights and see what everybody's doing. We're going to talk about bonds in our special segment in a second, but we do want to, introduce people to something. So we've got a new link database. I don't know what's a link page with all the AJ's links to all the stuff. You got his indicator suite, the YouTube channel, TikTok, Instagram, Facebook page, access to the daily workshop, information on how to join the training trainer program, and then coaching. So I'm going to go ahead and throw the link to that in the chat. We're going to encourage everybody to go check out whatever they want. We're going to continue to work on this. AJ's profile pictures is in the works. Maybe by the end of the day, we'll get that in there. But with that, I did mention the daily workshop. I'm going to throw another link specifically to this because if you haven't followed along with some of the strategies, you may want to get insight to know or to better understand some of the examples that you're going to go through later. So this is a great resource for that. But we're going to take a break here. We'll be back in a few minutes. As always, we're live. So if any of you guys out there have some questions about what's going on in the market or some ticker names, feel free to throw it in the chat. We'll be sure to try our best to get around to it. Sit tight. We'll be back in a jiffy.
You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. I know that you were talking about bonds a moment ago and the shift in capital from maybe equities to bonds. But your segment for today is an extension of that when looking at different time frames of bonds. So let's get into it. What are you seeing? What are you thinking?
Well, first of all, I have this graph up on my screen. Let me go ahead and zoom in on it a little bit if I can figure that out. Yeah. So this shows some of the bonds, right? This is the 2-year bond. This light blue one on my screen is the 10-year, and the dark blue is the 30-year. And so if you go back to 2021, the end of 2021, you see that kind of makes sense. You know, if you think about it, if you put your money into an investment that goes longer, you should, in theory, be paid more, right? For putting that investment in. So if you put your money into the 30-year bond, you get more return than if you put your money into a 10-year or a 2-year. The longer you lock up your money in a passive investment, in theory, the more money you should make. But what you can see with these 2-year, 10-year, and 30-year is in the last 2 years, it's got kind of muddled to the point where actually the 2-year, and I can actually, let me show you guys something else. If I come over here, actually, let me come over here to my watch list. I keep track of these bond prices. It'll come up in a second, depending on how fast the CNBC website works. There it is. So as you can see here with the bonds, right now, if I put my money into a 3-month bond, we're not even talking years, I'm going to get way more money than if I put my money into a 10-year bond. That's called a yield curve inversion, right? And so just to give you an idea on that, you guys can still hear me?
We're all here.
Okay. Sorry about that. Here is a graph that shows the difference between the yield curves, right? This is specifically the 10-year and the 3-month. And so take a look right here. This is the 0 line. And I'm looking at all time, which in this case seems to be about maybe 15 years worth of data. And you'll see here that we're below that, which means, again, you can make more money if you invest in the short-term 3-month than if you did in the 10-year. And let me actually click on this button one more time, all time. All right, now this brings us all the way back to 1984. And again, I'm going to highlight here the 0 line SIP because I want you to see this. Here's my 0 line. So as you can see in history, it hasn't been often that the yield curve inverts. And it usually is like just for a short amount of time, and it's just a small inversion. This, by the way, was the dot-com bust. This one over here was the Great Recession. This one was leading right up into the COVID area. And what usually happens when you have this inversion through history is when you come back, when you cross back above the 0 line and things start to get back into alignment, you're thrown into a recession. That's what's happened historically. And now for most of 2023 and 2024, we've been in this yield curve inversion. And economists and people like me, and again, I'm wearing the hat, not the hat that I wear where I can profit from anything. I'm not worried about the investor side of myself because I could figure out how to make this work. But from just the overall person who is going to be affected by economic downturns and stuff, this doesn't look good, right?
Yeah, especially when you compare it to the 3 previous periods where we as average folks knew that there was some trouble along the way. And so what you're saying is this is an indicator to some bad stuff happening.
So now I've got one more piece of data that I want to give people, and I actually have, because I know we have so many viewers, and I know we have some top-notch viewers. I'm gonna at the end of this little segment, I'm gonna ask for maybe you guys to chip in here, but don't forget that and we talk about this during this show, the Fed is aggressively selling off bonds, right? they've been doing this quantitative tightening. If I take a look, they were up at $9 trillion. This is all the buying that they did during the COVID pandemic when everything came to a stop. They're coming back down. And this was the initial buying. They initially, like within an overnight decision, bumped up their Fed holding by like $2 trillion. So we're almost erasing the gradual that they did during the pandemic. But that initial bump, they've said that they would like to keep selling bonds to get to where they were prior to that bump. And if you look actually before 2008, they were not really in this bond buying and selling business at all. And to get through the Great Recession, they started this kind of tactic because they didn't want to, like other central banks, do negative interest rates. So they did this tactic instead. And it's almost like I've heard some economists compare it to like being on heroin. Once you start using this type of technique for moderating the economy, number one, you can't really leave it, right? Just like, you think of a drug addict, it's very difficult for them to kick the habit. But then the other thing that happens is the tool doesn't work as well, right? You get used to it. So in order to get through the Great Recession, they did this, and it was just like literally about a $1 trillion, purchase of bonds. In order to get through the pandemic, they had to do a $5 trillion, and the pandemic was not nearly as troublesome for the world economies as the Great Recession was, but it took $5 trillion. So you can see that the tool kind of loses its effectiveness and you have to use it more. But in the long run, economists are questioning, and why am I bringing that whole thing up? Well, because that selling of bonds by this customer, the biggest customer in history, the Federal Reserve, might be causing that yield inversion. And since this is the first time that the Fed is aggressively selling bonds into the market, flooding the market with these bonds, it might be accounting for that yield inversion. And so,
but that would be different than the previous times, right?
Maybe. We don't know. It's never been done before. So we have no idea whether or not what I'm worried about should be something I'm worried about. Even BlackRock, right? BlackRock's got a lot more analysts than just me behind my desk. BlackRock wrote this article about quantitative tightening and, all the components of it. And, it's interesting because they've got some good pictures. I actually pulled one of their pictures up. This shows, what the Fed has been buying and selling. This yellow, which they never even, touched until 2008, is mortgage-backed securities, right? And also maybe some corporate bonds. The dark green is your greater than 5-year treasury bonds, and the light green is less than 5 years. So you can see they're flooding the markets since about the yield inversion. They're flooding the market with all of these bonds, and that could be something that's causing that price to drop. If I look, one other article I can draw people's attention to is this CME Group article. They talk about what can swing treasury yields. And this was the big one that has never been in the bullet points before. And it's this quantitative tightening, what the Fed is doing, right? Usually when we're worried about the yield curve, we're worried about inflation, we're worried about growth, stability, and of course, budget deficits of the different nations participating in the global economy. So that was what, and that could explain the yield inversion being so, recession, leading up to a recession. But this is the new one, the quantitative tightening and quantitative easing by the Federal Reserve. So I guess my question is if we've got some really smart math people out there, I would love for you to communicate with me about how we can factor out the Fed's influence. Maybe it is looking at their every Thursday public reporting of their whole Fed balance sheet. Every Thursday evening, it's by government mandate. We all have access to it. It's on a website. You can see the Fed balance sheet. Maybe there's a way to take our yield curve numbers and factor out the effect of the Federal Reserve's quantitative tightening and readjust our 3-month and 10-year ratio and see whether or not it's as alarming as it looks like when we don't factor out the Fed tightening.
So then, when looking at this chart, what is an indication of health? Like where at what level is a productive ecosystem?
Unknown, right? Because again, this is the first time, Sip, that the Fed has been, in 2014, the Fed decided to sell a few of their securities that they had bought between 2008 and 2014. And it caused such a shuddering in the market that they stopped. They were worried. And so they stopped. They stopped selling. They did it for just like a month or two, and it created such ripples that they decided to just hold, right? Again, you can kind of see that in this graph of right here. Nope. I got so many windows open. Here it is. You can sort of see right about here where they started to try to do some selling, and it caused so much chaos that they stopped. They actually wound up buying some more, and then they held. And yeah, this was not actually selling off. What they were doing here was letting this was 10 years, this was 2018. They were letting some of those bonds simply expire, right? And cashing them in that way. They weren't actually selling them. They were actually coming to fruition. Bonds expire after the number of years. So that's why you see the Fed balance sheet dropping here. It wasn't because they were actively selling. Since May of 2022, they have been actively selling. So this is the first time, and that aligns with this whole thing happening here with the Fed, the 3-year and the 10-year inversion getting wonky. This is new territory, never done before. And so my question is this scary, right? Or is there a way to factor out this influence? Is what the Fed's doing scary, selling these bonds? And the next question is can we factor out what they're doing from the 10-year and 3-year, basically adjust the 10-year and 3-year bonds to compensate for what they're doing, to negate what they're doing, so we can get a better picture from on our graph moving forward, get a better picture during these last years to see, is this actually as significant as these 3 past events that caused incredible recessions? And I know I might be asking for some college level stuff, but if you guys out there can help me figure out how to negate the quantitative tightening from our 3-year and 10-year prices, basically adjust them to not take in what the Fed's doing on a weekly basis, so that we can get a more accurate 10-year, 3-year yield curve, I'd be at everyone's debt.
Yeah, and I'm sure there's some smart people out there working on it, because it is new. It is new. But what I took away from all of that is that the members of the Fed are on heroin, and they have this tool that they're very much addicted to that has a great impact on the economy. And we as consumers and citizens should pay more attention, because like you said, it was introduced in like 2008. So when we draw comparisons, market comparisons to anything before that, it's almost not a fair comparison, because we've been using this tool in the back end to keep things up, and now we're trying to keep things down, and it's just like, okay, man, there's a lot going on. We should be aware and pay attention, and we should tune in to see how we can make some money from it, because at the end of the day, we're going to take off our consumer, our citizen hat, and now we're going to put back on our investor hat. And what I love about this show and what I love about what we've been doing is that no matter what's going on in the market, if it's going up, if it's going down, if it's going sideways, you and the team have strategies to take advantage of it. And that's what we do here on the show. And every week, let's go. What do you got?
Well, I just want to, you said something really important. And the first bullet point at the top of this BlackRock article from June 3rd basically says the Federal Reserve's balance sheet is one of the world's most important security portfolios, yet its ongoing importance for markets and financial conditions is often underappreciated, which basically means people aren't paying attention. Sip, you and I talk about, and we pay attention to
every week.
But I'll be honest, when they have their Jackson Hole meeting every year, when they have their press conferences, they rarely ever mentioning what they're doing behind the scenes with buying bonds and selling bonds. And it's really, it's something they're doing that's changing everything and that we have to take into consideration as investors. But you're right. I have the tools. Everybody who does options the way we do has the tools to figure it out and to profit from it. But it is alarming that they're doing all of this behind the scenes and not really making it so public.
And what's good about the reason that we bring it up is so that we can educate, so that we can learn a little bit more about it and bring it to awareness. But with all that being said, we'll keep an eye on bonds. We'll continue to reference that chart because it has been coming down, which is good in the long run. But this week, you've got a banking name on your radar that there might be a potential upcoming play. So your pick of the week this week is New York Community Bank, ticker symbol NYCB. What are you seeing here, AJ? Ooh, look at that. Look at that range right there.
This is one of my favorite symbols to trade. I've been trading this symbol for about 15 years on and off. And it's in one of those patterns, right? One of my favorite option strategies is a range-bound premium selling option strategy. Range-bound means if the symbol stays in a range, we're going to make an income off of it, right? And we leg into this position. Basically, we set up the position initially, and then about once every cycle, which it looks like the cycles are running roughly monthly, we're going to do one adjustment or two adjustment trades, 1 to 2 trades. So I'm not talking about, day trading here. I'm talking about once a month coming in and adding or subtracting a position from the overall option strategy. And this is going to create a monthly income stream for us. You can see it. Any other trader would look at this and say, this is the ugliest looking position. There's no way you can profit on it. But with options, and also with the increase in the VIX, the increase in implied volatilities, we're going to be even making more monthly income off this, because when we sell an option that ultimately expires worthless, we're getting top dollar for it right now. So I'm going to zoom in on this chart, Sip, and we're going to take a look at the last 3 months. You can see I've got these signals here. This is my free indicator. If you go to that link page, it's right at the top on how to get our free indicators. Basically, you get free access to our portal, and then you can go into the portal and you can download those indicators. While you're in the portal, read some of my white papers. I got all sorts of stuff you can access that's really valuable, other tools that you can use. But you can see my free indicator here. This is the Fast MACD indicator we've talked about in the past. It's given me a signal. I've gotten a couple of days of possible follow through. We're at a point where we want to short New York Community Bank. Either short it or we can use a substitute option. So the substitute option would be a put option. They would be far out in time. They have an April option, April 2025. I've got it queued up right here. And the one I'm looking at is this $16 strike price. By the way, New York Community Bank is well priced. Even people with small portfolios can afford it. So I'm looking at this $16 put. So I'd either buy this $16 put that doesn't expire until next April, or I'd short the stock. That's how I would start this position. And then basically every time we hit our support level down here around $9.25, I would sell my put premium, buy my protective call, all on the same day. That would create my income stream. That put would go ahead and expire, because when we sell put premium, we're selling it, near term, no more than about 3 to 5 weeks out. And then the protective call we're purchasing more like 6 months out. And we'll simply put those two trades on, create that strategy where as the put, ages and gets closer to expiration, it winds up going down to zero. The call premium can then be sold back because we don't need the protection anymore. Usually we sell it back for a little bit of a profit, and then we just repeat the cycle. And New York Central Bank is poised to let us repeat that cycle for at least the next few months.
Yeah, that's a great setup. And Doug thinks that too. He mentioned I'm in that one. It's working like a dream. I know there's a few names like that you like to bring up on the show that are a little boring, but fit very well into these ranges and the reversals and things like that, which is why it's your pick of the week. So there it is. New York Community Bank, ticker symbol YCB. AJ's pick of the week. All right, we've got some pretty good names in the speed round. These are all names that everyone should be familiar with. So let's dig through some of these names and see if we can get your indicator to give us some good signals, what the plays are. We'll go ahead and start with Todd from Little Rock, Arkansas, who wants to know Goodyear Tire, ticker symbol GT. I feel like that's one of those names that has this type of, oh no, it's looking like it's breaking.
Yeah, but you're right about that. Goodyear Tire has been on my radar as well for over a couple decades. I think I was trading this in the late 90s. What you can notice is that I just pulled up a 2-year chart. You'll notice that Goodyear goes sideways for about 6, 7, 8 months. Then something will happen. It'll pop out of its channel and then go right into another channel. It'll pop down from its channel and then it'll start going into another channel. So what's nice about these strategies is when you have your protective option purchased and you have your premium sold, you're basically protected. This position's going to automatically adjust, and it's going to adjust way better than any stop loss order would ever adjust it. This passively adjusts it penny by penny. So you don't care if the symbol finally breaks out of the channel to the top or the bottom side, because your protective option and your sold premium create that range where once it's out of the range, it self-adjusts. So our strategy is pretty awesome, Sip. And so I don't care that it actually dropped. What I care about is, are we in a new sideways channel at this new price point? So let's take a look. I'm going to zoom back into a more recent chart. It looks like we fell to somewhere around $7.50, $7.75. Then we had a little bit of a rebound up to $9, and now we're back down. Here's what I'd want to do. This is for Todd. Here's what I want to do, Todd. I want to make sure that this $7.50, $7.75 is actually going to be my level of support. So I don't want to do anything until I actually get my signal. You can see my signal came last time. I want that light blue arrow to show up again in order to kind of build confidence that that's my level of support. I always tell my program participants, levels of support, levels of resistance, it becomes mature when you at least have 2 tests of each. So if I get a bottom, Todd, that's when I'll say to myself, okay, I think maybe it would be worth my while to buy some Goodyear tire. I could buy the stock, or I could buy a substitute call option. Again, you want to go out at least 8 months in expiration, and you want to go very deep in the money so that there's very little extrinsic value, almost all intrinsic value. So it makes a good option or stock substitute. So either one of those. And then as we head back up in our channel, if we stop where we had resistance at 9, great. Sell your call premium near term at the money. Buy your protective put down near your break-even price. Make that 3 to 6 months out. Error on 6 months and let that work. And as that premium expires and you roll out of that protective option, look for the next opportunity to do that. But we first, and this is the most important point, have to establish that level of support. Don't do anything till you see that signal.
Priced very well, and tires, right? Not an exotic business or industry. People,
No.
So the probability, unless there's some, financial
They've
stuff
been around for
yeah,
forever.
exactly. So one of those good names to add to the watch list to use that premium selling longer term strategy. So there you go, Todd. AJ's breakdown for Goodyear Tire. Our second name, a name that we cover frequently. This is Cindy from Tucson, Arizona, interested in American Airlines, ticker symbol AAL.
Yeah, you guys are bringing back all the stocks that I like to follow, right? When you find, here's the scoop. I'm going on a little tangent here. When you find a underlying stock that's sideways channeling and has done it, in history, yeah, there'll be periods where something happens for the company or for the sector or even for the overall economy that makes it pop up or pop down. But the investors that are attracted to a Goodyear tire, the investors that are attracted to a New York Community Bank, the investors that are attracted to an American Airlines are more attracted to its dividend or for other reasons than for asset appreciation. In other words, the stock tends to get into these ranges of sideways choppy movement, which is where our premium selling option strategy just excels. And you'll notice if you look at all the stocks, for the majority of time, all of them are in sideways choppy channels. It's more rare for them to start trending up or down. So the fact that we're armed as option traders to be able to make money on sideways chop is just like the bee's knees, for lack of a better way of saying it. So let's look at American Airlines. American Airlines had a little, dip of it. You can see we were looking at it trading up here, and it came down and it downtrended. Same thing. It looks like it maybe found support at 9, and maybe there's resistance at 11. So we're going to flip-flop. Instead of using a, bull call diagonal debit spread, we're maybe thinking about a bear put diagonal debit spread. What does that mean? It just means we're reversing the directions. Instead of looking for a bottom reversal like we were in Goodyear Tire to test and reinforce our idea about what support is, I'm going to be looking for a top reversal around $11 to reinforce my idea about what resistance is. And so when I find a top reversal, I'm going to, instead of buying stock, I'm going to short stock. Or the other option is, instead of shorting stock, I could buy a put option. Again, far out in time, deep in the money, almost all intrinsic value, so it makes it a good option substitute. So for this one, this is Cindy. Cindy, I don't want to do anything until American Airlines proves to be, with one of my magenta arrows, that $11 is resistance. Once it does that, I'll do exactly that. I'll set up my premium trade by shorting the stock or buying that back month deep in the money, far out in time put option. Once I have that in place, either one of those or a combination of those two trades, we call that our initial covering trade. Once that initial covering trade is in place, I'm set to sell, put options, buy protective calls every time we dip down to the level of support around $9. Create that cyclical income stream. So same thing, only flip-flopped.
And also priced very well. So that's two names in a row that are roughly $8 to $11, which is great for any of the smaller portfolios of users that might be looking for some opportunity. So thank you for that, AJ. Thank you for that, Cindy. Moving on to our third name. I feel like this one's in the news this week. Billy from Detroit, Michigan wants to know about Ford, ticker symbol F.
So again, I'm going to start with a tangent. We drove it should have been 7.5 hours. It turned out to be 10 hours because we got caught right at rush hour in New York City, which I don't know if you guys ever went through rush hour in New York City, but it can turn a 15-minute drive into a 2-hour drive. We took our Ford EV. This was our first road trip in our Ford electric vehicle. And I was so surprised. It was so easy to charge up along the road. We charged up just outside of New York City in New Jersey, and was able to make it up here with just one 16-minute charge.
16-minute charge? Wow, that's impressive.
Yeah. It was very awesome. And I had never done that. I've only been charging the EV at home, overnight with a normal just electrical outlet. So I didn't know what the supercharging, what it was going to be like. But by the time we got out of the Mike's Jersey subs with our little subs in hand, it was done charging and we were back on the road. I was pleasantly surprised because I've heard a whole bunch of negativity around that, and that wasn't my experience. So with that said, Ford also has been in the news saying that they're pulling away from the whole EV craze that was happening in 2021, 2022. I think they put on hold without a date to restart. They were going to release some SUVs that were in the EV world, and they're going to put that on hold. They've repurposed some of the factories that were set up to be EV factories to produce just regular Ford F-150 trucks. And so that kind of bummed some people out. That took also some of the investors by surprise. And nobody likes to see a change in plans. But, Ford has to do what they have to do in order to keep profitable. And so I get it. But, hey, looking at the chart, Ford is yet another name. We've got four names, including my pick, that I have been watching for decades. And I recommend you put these 4 names on your watch lists because these 4 names do tend to go in and out of these sideways choppy patterns, which are perfect for premium selling, especially today when the VIX is so high and we can get extra large premiums. So Ford looks like it found a level of resistance up here around $11.25. I got my pink arrow already. I've come down. Yesterday, we actually got follow through to that pink arrow. So yeah, we want to go ahead and short some Ford and or buy a back month deep in the money, far out in time, put option as a substitute. Get one so that it's mostly intrinsic value, very little extrinsic value. That will be our initial covering position. Who is this? This is Billy. Oh, Billy, you're right in Detroit, right on. So that's what you want to do to set up this trade, and then we'll see what happens. $9.75 is where we want to see a reversal back up. Whenever we get that reversal back up, we're basically going to sell our put premium, buy our protective calls, and let that trade just cycle. Those are the 2 trades you're going to do on the same day. once that premium expires and you roll out of that protective call, you just queue up and do it again and again. This could be a monthly income producer for you too. So yeah, I like it. I like it.
All right. Ford, Billy from Detroit probably has some insight, seeing as that's Ford land over there.
Can I tell you something that's absolutely insane? So I'm in the hotel, right? And I told you that my friends from Italy, it was actually Sardinia, which is an island not as big as Sicily, but it's part of Italy. But if you ask the people, the Sardinians, they would not tell you that they're Italian. They would tell you that they're Sardinian. It's just ironic that Italy is in control of their island. So I lived there in 2014, 2015, right? Scuba diving every day, living the life in a Mediterranean village. And I met these people, and some of them are circus performers. I'm on the 8th floor of the hotel here in Providence, Rhode Island, and they have a crane set up, and I'm watching them practice right now, and I'm hearing this music. I don't know if you guys are hearing the music through the window, but there's this huge cube over the city of Providence, Rhode Island, with these people floating. It's very distracting. It's awesome.
Well, they're just prepping for the main event, right? They're making sure the spectacle would be as exciting as you're seeing it now. So that's
absolutely
awesome.
In fact, we went down to the restaurant in the hotel for breakfast, and when we were up, the elevator door had opened, and they all came in, and they were like, "Hey, Jay," speaking Italian to me and everything. And they liked seeing the little toddler because they've seen only pictures of her on Instagram. But it was neat. And now they're all out my window on a crane. So it's cool.
That's awesome. And what else is cool is the way that you can travel and meet up with friends and continue to invest,
do this show
and do the show. It's a wild time that we live in, but at the same time, if you, the viewers, aren't living such a lifestyle, maybe you should consider using options and joining the program and getting more involved. But AJ, we don't want to keep you too long because it looks like you've got a nice weekend planned. The market's continuing to sell off, so it seems as if
let's do one last look at the SPX here.
We're heading into the weekend near some of those support, or not even just, I don't know what we would call the purple area, but heading into the weekend, mark.
We call that the center zone.
We're selling off, so it's looking like some of our options are going to be priced a little bit better for us to sell premium, and we've got some opportunities for the rest of September.
Yeah, I'm looking for the S&P to actually sell. For us premium sellers, we'd be in Fat City if the S&P came close to the previous lows. So I'd actually love to see the S&P drop probably another 250 points. That would make me, and I know, again, my one hat, which is concerned citizen, my other hat, which is investor. The investor hat would love to see definitely a pullback of the S&P below that center zone. So that center zone ends at 5,362.84. So I want to see it go down below 5,362.84. But I'd really love to see it not reverse until it gets down to 5,186.33. So again, I wouldn't be upset if the S&P pulled back about 200 to 250 points before heading back up for its next upswing.
All right. Well, we'll go ahead and leave it at that.
I don't mind that the VIX is as high as it is, Sip. Because us premium sellers, we're cashing in on all this uncertainty because, again, we're selling. We're on the correct side of the transaction. People are like hand over fist buying options, and here we are being the people saying, okay, you can have it. Top dollar, please. Top dollar, please.
That's right. And so if you are watching, you've enjoyed the broadcast, you want to show some love, head on over to that link that we pasted in the chat. We've got some free indicators. We've got links to the socials. Show some love. Hit that like, hit that follow, hit that subscribe. If you have any questions along the way, feel free to throw it into the chat. Send us a DM. Someone will get back to you. Otherwise, head on over to tradingtrainer.com. There's a contact section there. And if you're not a member, you should seriously consider it, because in some of those mastermind sessions, the team goes into a lot more than we just discuss on the show. And so that's where the real magic happens. So if you're not already a member, seriously consider it. AJ, thank you for your time. Everybody, thank you for tuning in. That's all I got on my end. Any final words?
No. Have a great weekend, everybody. I'll see you next Friday. Next Friday, 150 shows. What?
That's right. We need to do something special. So stay tuned, folks. We'll come up with a nice little surprise.
Square. We're gonna have a surprise.
All right, everyone. Have a great weekend.
Thank you for tuning in to the AJ Brown Show. If you're interested in learning more about AJ investing techniques, trainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh